Ideally, we started with 28,000 days. By just the 0 to 20 and the 60 to 80, we have been cut short by 14,000 days, which makes it 40 years. So you need to figure out, what are you going to do between now and 60 to make it work? But also, you need to understand that there are 4 fears that will come up. And those are universal fears. What if you cannot work till 60? What can stop you from working? Of course, critical illness, permanent disability. What if you do not reach 60? What do I mean you do not reach 60? There is death. We have so many people passing on at 30, at 40. What happens? Do you have a life insurance policy? Do you have a fallback position? Do you have a treasury bond that you have informed your family about, that is through your commercial bank? Do you have a unit trust? Are you involved in a circle or in an investment club? Do they know your assets? Have you been able to share this information with your estate manager or your administrator? If that's so, do you have a will? Have you shared that with your lawyer? So those are things you need to think about. Then how much is enough to retire? These days, gone are the days when we knew you retire at 60 or 65. These days we have what's called the hybrid retirees. The hybrid retirees are people who have said to themselves, I am going to grease on, I am going to work so hard, and I want to retire at 40 or 45. But the thing is, how much do you want to retire? Is it $1 million? Is it 500,000 US dollars? Is it 100 million? Is it 200 million? What is sufficient enough for you to retire comfortably? Now, the other fear is, how can I ensure that my kids start with the right foundation? When I mean the right foundation, what are we talking about? We are talking about education. Education is the best thing that any parent can give their children. So that's what insurance does. With insurance, you're able to have education policies, you're able to have retirement policies. With that said, Satish, can we just go to the next slide? Thank you. When I talked about education, I talked about education planning. Education planning is one of the things that is synonymous, with insurance. Right now, I know there are mothers on this call, young mothers on this call who are entrepreneurs. If you have a kid right now who is 2 years old, do you know that in the next 10 years, your child will be going to S1? In the next 16 years, your child will be finishing their A levels. Are you going to wait and say till you get there is when you cross the bridge? If you're 30, do you realize in the next 10 years you'll be 40? In the next 20 years you'll be 60. So why aren't you, if you know that indeed, whether you like it or not, your child has to go to school. Whether you like it or not, you're going to age. Age is not static. We tend to be in denial and we hope that we'll have that breakthrough, we'll have a windfall, we'll get that one, we'll get that deal that will change our lives. But you need to start planning right now. Would you rather start planning when your child is 2 years old, when you still have a disposable income and earn interest? Or would you rather wait 10 years from now or 15 years from now, whether you're uncertain if you'll be alive, you're uncertain if you have an income stream, you're uncertain if you'll have that job. So it's important that you start saving right now and investing so that you're able to earn a bonus rather than waiting, borrowing, and then have to pay interest. That's how we drown ourselves in loans. That is how we liquidate our properties. Now, we're thinking about, okay, people talk about retirement, but the truth is, are we actually ready for retirement? Do we know what it takes to have a comfortable retirement? If you look at the statistics with our NSSF, actually, you'll realize that only 40% of what is paid out for pension replaces our retirement. What do I mean? What happens to the 60%? Where is the 60% coming from? Where is the 60% coming from? Do we have other assets? How are we managing our assets? How are we managing our income sources or income streams? So you need to have an understanding that the earlier you start, the better. And I know some of the mothers here have gone into sole businesses, they've become business owners. And the fact that you've become a business owner might be that you have actually stopped even doing voluntary saving. Are you doing voluntary saving? Since your employer stopped putting that money for you, have you even taken Have you actually gone to NSSF and say you want to do voluntary saving? Are you expanding on your folio? Is your money growing in your NSSF pool, or it has become static? So it's important that you understand right now, if you stopped formal employment and you've gone into becoming an entrepreneur, I want you to go and look at your NSSF statement and look through it and analyze it. If you are standing at 100 million or 70 million, is that sufficient for you at the point that you're 70 or 80? What are the things that you need to do to supplement into that retirement? Yes, you might have a business, but a business is also a risk. It could be seasonal. One moment you're in business, the other day you're not in business. So you need to have what we call these safety nets. You need to have a buffer to mitigate these issues. So with that said, you need to apply the financial skills and knowledge in order to help you understand where you need to be and where you're going. And remember, a true asset in old age, guys, cash is king. At an old age, cash is king. A true asset in old age is liquidity. So if you've been playing around with high risk financial instruments, this is the time when you get to a certain age, above 50, you need to start transitioning from what we call variable to guaranteed income. And remember, people on the call here, members, if you fail to plan, you plan to fail. So basically, you need to understand what are the potential sources of income at a point of retirement. We have rental income, we have from bonds, we have from FDs. FDs are fixed deposits. So we're looking at the potential sources of income at retirement. Of course, most people, the culture has been that we buy land, and that has been the culture, and that has been the modus operandi. But things have to change, because if you wanted to liquidate, you had a problem, you had to liquidate right now. It's purely dependent, it's highly illiquid, meaning it's purely dependent on, of course, willing buyer, willing seller, i.e. dependent on the market. We can, of course, get other sources through coupons from bonds. You can buy a government bond from your commercial bank. Just go to your commercial bank and ask your relationship manager to advise you on what would be the best bonds, but bonds are usually long-term. You can also have a fixed deposit, what we call FDs. FDs are usually done for a year or two. We also have treasury bills as well. Treasury bills you can do for 3 months, 6 months, mid, short, and also long-term. They usually give you an interest dependent on what it is that you have deposited. And of course, there is also a tax implication. You need to be reminded that whatever financial instrument that you want to partake in has a tax implication, i.e. you have the ledger fees, you have the withholding tax. But insurance, life insurance, is the only financial instrument where you do not have a direct tax implication. So you also have dividends. We have dividends from shares, from preferred shares and income generating shares. For example, if you look at our stock market, we have Stanbic, we have Uganda Clays, we have New Vision. But out there, they have very big vibrant stock markets that are worth billions of dollars. We have Google, we have blue chip companies that are trading on a high. But you also need to realize, what kind of market are you playing in? Our market in terms of shares is a very limited and non-robust and not very vibrant. So it's not bad to have these shares. It's okay, but you need to think about them long term. It only makes sense if you have the ability to wait. Some of these financial instruments is about how long can you wait. Even in the property game, if you're not a kind who is always flipping property, if you're not the kind who is into the development, infrastructure, development in terms of real estate, are you ready to wait? For example, there's some people who bought in Tinder 10 years back when a house about a 50 decimal, a 12.5 decimal plot, which is a 50 by 100, was going for about, let's say, 45 million. Right now, if you're to get a 50 by 100 decimal plot, it's actually almost 500 million. So yes, but are you ready to wait for all that? While you're waiting for these capital gains in terms of your assets, i.e. the property, what are the things that you're doing in the interim period to build on your financial portfolio? Of course, we have pensions from government, i.e. your NSSF. But remember, some of us have become entrepreneurs. We're no longer in the formal space. We do not have employers. So what is it that you're putting aside to take care of you at a point that you retire? We have also income from endowment, i.e. annuity policies. These are your life insurance policies. And the advantage with life insurance policies is you determine the period that you want to save for. You can say, I want to save for 10 years. I want to save for 5 years. I want to save for 15 years. So there is that flexibility. And in the case a risk does not occur, at the point of maturity, you're able to get back your money. So remember, life insurance and retirement plans, you need to start thinking, the older you become less averse, you become less risk averse. When you're younger, you can play around with your money because you know you have a fallback position. But the older you become, it's more like diminishing returns, the law of diminishing returns. The older you become, you're not so sure that you will have an income. You're not so sure whether you'll even be there to provide for your family at a certain stage. So you need to start building what they call a nest egg. Start nest padding right now in order to have a steady flow of income. Dear Satish, can we just go to the next slide? Thank you. Now, with that said, you need to understand, what do we mean by the ABCD investment strategy? Now that you know what you're going to do, you need to understand what assets can you invest in. Are you one who is entirely doing land? Are you one who just does commodities? With that said, you need to understand whatever asset you decide to choose, whatever asset classification you choose to partake in, what is the risk and the return of these different assets? You also need to understand, what is your risk appetite? Some of us said, I'm ready to go. I want to make the money. Are you ready to go into crypto money? Are you ready to go in the cryptocurrency space? Are you ready to go into forex trading? Are you ready to put your money into something that you do not know how it works? So you need to have an understanding. And of course, you need to know the ABCDs of the investment strategy. Kindly go to the next slide so that I can just talk about the risk and returns of those different asset classes. Thank you. Now, when we talk about asset classes, just like I spoke prior, we have the property. In terms of liquidity, it's highly illiquid. What do I mean? Today, if you were to liquidate and you had an issue, how fast can you get that money? And of course, in terms of volatility, it is definitely dependent on the market, willing buyer, willing seller, and it's all about price. Everyone wants to make a quick buck. Everyone wants to be able to make a substantial income. If you bought land for, let's say, at 45 million and you sell it in 2 years, you do not want to sell it at 47 or 50 million. You want to be able to double that money. So you also need to know, what are the yields? It's known to give a very stable, you know, they say the power of compound, just like the power of compound interest. Land is one of those that takes a long time, but when it comes through, it really comes through. It's a total windfall. So you need to understand that it's quite stable. When it comes to equities, it's definitely liquid. It's known to be high risk. We're talking about stocks and things like that, and it's known to have a higher return. But as well, when you to have a greater loss, it will be also a greater loss because of the risk perspective. When we talk about bonds, of course, this is dependent on the market demand. You usually realize in our market, especially in Uganda or Africa predominantly, the government is willing to give a certain higher percentage because they want to borrow money towards election and things like that. So it's always important to understand the trends at which you can buy a bond. And of course, that's dependent on the market, and it's known to give a very stable return. And they give these, the returns are usually given in form of what we call coupons. And if you buy a bond today, let's say at 30 million shillings, for example, you lock it for 5 years, you will get a coupon of about 1,660,000. But because of the tax implication, they will give you about 1,330,000. Meaning every month you actually, out of the 30 million, you're earning 230,000 shillings per month. But you'd rather have something earning rather than your money. Your money should always be growing. You'd rather your money is not static. Never leave money in a state of dormancy, because there are things like devaluation, there's inflation, and all those actually can chip into your financial portfolio. We have commodities, which most of the ladies here, I believe, deal with, i.e. when I talk about commodities, we're talking about things like rice, sugar, we're talking about the logistic business, we're talking about gold, we're talking about oil. It is known to be of high risk, and it's also known to have higher return. Of course, cash is liquid, cash is king. Some people could have missed this when we're talking about the different ways of you having an understanding of how to spend, how to save, how to invest, the taxation element, and the perspective when it comes to budgeting and knowing your 50, your 30, and your 20. You need to have a deep understanding on how to differentiate between your needs, your wants, and your expenses, and your tax elements, and your asset classes. And one of those was about the behavior part of it. And the most important thing, I'll just share one of his quotes by Warren Buffett, who says, "Do not save what is left after spending, but spend what is left after saving." So as soon as you get that profit, replenish it back into the business. Put something aside and see how you can get other income, how you can make money through different income streams. And I'll just tell you about who we are as Prudential and why you should invest with us. Please remember, you need to have what we call a 360 balanced financial portfolio. If you're looking to speak to an advisor regarding to how you can have protection for your family, you need an education policy, you need to have a safety net, you need a buffer, you need a unit trust, please don't hesitate to call me. As I told you right from the onset, I do give custom-made policies, tailor-made policies to suit your financial need, be it a short-term, medium-term, or long-term. Who are we as Prudential? Prudential is one of the highest capitalized insurance companies. We trade at, our assets under management is about, as of 2019, was about 948 billion pounds asset under management. We have about 29 million policy holders. We have our footprints not only in Africa, in Asia. We're listed on the stock exchange in the US, in the UK, and 6 other Asian markets. What does that tell you? It tells you that we have been in the business for about almost 200 years. We're the company that paid for the sinking of the Titanic ship, First World War, Second World War. Why I'm giving you all this information is because you need to understand where we're going, understand what kind of company you're investing in. We are a highly robust, capitalized company, and I believe we're the suited company to give you the financial needs or to meet your financial. We give the best financial solutions to meet your financial needs. With that said, I'd like to let you know, tell you that please start now. We never know what can happen. The black swan is a myth. It has come. The pandemic is here. And we now know that anything can happen. With that said, have those shock absorbers, mitigate the risks, and I'm here to help you for any kind of clarification or information. Thank you very much. And I'll just let's head to our learned Fred, who is in the legal space. Thank you once again, and you guys stay safe and take care.